welcome to Your Money, Your Call. I'm Julia Lee from Bell Direct. If you have a question about shares, our phone lines are open right now on 1300 30 34 35, or you can always email us on yourmoney@skynews.com.au. And joining me on the panel tonight, we're very lucky to have Evan Lucas from IG and also Ben Clark from TMS Capital. Looking at the market, a lot of nervous people out there. I mean, we've seen the financial space down by 6% over the past month and the material space down by 3%. So I guess the big question is, when's this going to end? And, you know, Ben, when you look at portfolios, are you positioning a lot in cash? Are you waiting for a bit of a deeper pullback? What do you think?
Look, I think this sort of day-to-day volatility is pretty, you've got to expect it. 5,600 to 6,000 appears to be like the range that we're trading in at the moment, Julia, and I reckon at that sort of 5,600, dividend support starts to come into the market, looks good relative to cash. A lot of stocks start to look attractive there. And, you know, we're really trying to find those stocks that we think have got good, like solid earnings growth in the coming years, and you don't really need to worry too much about the day-to-day volatility. And as long as, you know, you're still holding that company and it's earning a fair bit more, in 3 to 5 years the share price should be a fair bit higher. It's pretty simplistic, but that's what we're looking for.
No, I guess that's you know what people are looking for at the moment, a high yield together with growth. The problem is when you can find it, it runs so hard. Are you finding valuations?
I just think you've got to be opportunistic. Like, you know, as an example, the last week we've been buying a fair bit of REA. You know, that's fallen nearly $10 a share in the last few weeks. To us, it's still one of the premier growth stocks on the Australian market. So you've got to be quick. Like, you're totally right. There's not a lot of, you know, buy me sort of opportunities jumping out at you. You've got to be across, I think, a number of businesses that you think look good, and then if there's an opportunity in them, you've got to be quick and be onto it, as long as you don't think that something's changed with the business. And that's the thing you've got to get your head around and understand the business before the correction happens.
Okay, so have to be quick in this type of market, and I guess, Evan, a lot of traders will be hoping that 5,574 points is the low of this pullback. What do you think?
I agree with Ben to the fact that obviously clearly there is dividend support there. So once you go over around about 5.2, 5.3% in the banks, they obviously become attractive. There is nothing out there in this world that can offer you that same sort of yield. The risk around it and whether or not you can sort of justify the issues around macroprudential overhangs, whether or not you've got an issue around what's going on and talking around the housing market, whether, I mean, let's be honest, all a bank is just a very, very good geared loan book. I mean, that's what it is. And all of them look still very good. I mean, I know the Uber bears out there will clearly tell you that, you know, one of the banks is going to absolutely explode and die. I can't see that happening. It's very, very hard to even justify that. But I agree. I think the range is a bit tighter, though. I think 5,800 points has very clearly shown you in the last couple of weeks that that is the lock-in range. And I think the question that you originally asked, Julia, was where do I see the market going? And unfortunately, at the moment, I see more headwinds than I see tailwinds. I agree there are stuff out there, Ben, and we are always been a stock picker's market. The biggest issue I have is the US and the complacency that's been building over there. Their VIX index is sitting between 10 and 14. Their PE ratio is sitting at 18.1 times earnings, and that is dead set complacent. And they've got the Fed funds rate going to rise. Pretty much we've been told now, whether it's the semantics is which month, doesn't matter, it's going to happen. That's coming. Brexit's overhanging. You've still got issues around whether or not we're getting overheating in China. There's so many risk concerns at the moment that being a reactionary market, and we're a reactionary market, there is still, unfortunately, risk to the downside. And I think you may actually see, once the US starts to catch up, because it has been grinding higher on almost no news whatsoever, we unfortunately will get wrapped up in it as well, despite the fact that we've underperformed the rest of the world by 8%.
Okay, so lots to talk about. The Australian market has been underperforming, financials especially coming under pressure, but some stocks have been doing well, and we'll focus in on that perhaps later in the show, because we do have our first caller on the line. So let's go straight to Eddie from Adelaide. Eddie, welcome to the show. What's your question tonight?
Yeah, hi guys, thanks for taking my call. I wanted to ask you and the panel about nickel and pure play nickel stocks. I've seen an increasing amount of commentary on the web and newspapers and TV lately that we might soon see a sort of nickel supply shortage, which would obviously drive prices up. I believe from what I've read that this is due to Indonesia ceasing supply to China and also the Philippines running low on stockpiles. Can I ask you and the panel then, are these commentaries credible? And if so, what's the best nickel stocks to go for?
Okay, so looking at nickel, I think a pretty hot topic on the market, given that we've seen Independence Group with that takeover bid for Sirius. But, you know, a lot of other nickel companies coming out and saying that they're doing it pretty tough because nickel has been under a multi-year downtrend. And, you know, Independence Group probably picking up these assets at the low of the cycle. Now, Eddie's asking about Indonesia and how that impacts on the supply-demand metrics in terms of the market. Is nickel an area that you've been looking at, Ben?
Not really, Julia, although I think that the callers asked some good questions there, particularly in saying, are these commentators credible? Because, Eddie, from what I've sort of seen over the years, you know, for every time that, you know, people saying, you know, I remember when everyone said iron ore was going a lot higher, when gold was going to 5,000. No one really knows what the outlook for these things is. Indonesia stopped supplying China with nickel a number of months ago from memory. So you
almost
think,
a year, in fact.
Almost a year. So you think that'd be priced in by now. And I guess always the risk is that they start resupplying them out of the blue, which does happen with these sort of countries. And suddenly the nickel price falls heavily. So, you know, I think it's not something that we'd be too interested in. We're trying to like find companies that we think can grow their earnings without having to worry about sort of external prices and things that are outside their control. But if I was looking at a nickel stock, I reckon the independence deal with Sirius is pretty interesting. You know, I think if the analysts all seem very keen on Nova, which is the deposit that they've effectively bought, and I think there was a lot of scrip issued, and Mark Creasy wanted to stay involved in Independence Group's a good sign. So that's one to have a look at. But nickel...
The issue there was obviously the market thought it was too much of a premium. And the price pullback afterwards. I agree.
The prices come back to a long way now. So if you're buying now, you know that's factored in as well.
But Independence Group is the one probably out of all of them that is the most attractive. I agree with that completely. It's had, and you can see that in the share price. The run-up's been amazing. I think, Eddie, the other one you could probably look at, and it's not a pure nickel play, and that was your question. I understand that, but the one to talk about is South 32, and the fact that obviously the nickel deposit that's inside that is probably on the same size and par as what we're talking about with regards to Independence Group anyway, although nickel is not the major part of South 32's portfolio. It is certainly one to be aware of. But when you look at that and when you talk about it, the reason it's become what it is because they are seen as non-core and they are risk assets. There is certainly growth in them, no doubt there is growth in them if they get things right and if they operate and move their balance sheet in the right direction. But South 32 is a growth play from the fact that they've got a mountain of cash that BHP left them to do M&A. So does that M&A happen in nickel? Doesn't sound like it will. It sounds like it's going to be more along the lines of coal and copper. So I agree with Ben. It's an interesting one. Nickel is a huge risk asset. Look, it is trading at, I think it was 14,000 US a tonne last night in LME, but as Julie alluded to, that is a long way down from the 17,000 it was around about 18 months ago.
Sure, I think it's $12,540. Right. So it has been under pressure, down 35% over the past year. Some other nickel players on the market, just to put you on the spot, Ben, Western Areas, Panoramic, what do you think?
Julia, it's really not an area I pay attention to. Like, I'd go the other way on South 32. I think it's a sell. My view is that the spin-offs out of BHP have been atrocious. You know, if you look at BlueScope and Arium, and you know, there's a lot of geopolitical risk in a lot of the assets, and generally I just think if BHP doesn't want to own the assets, I don't want to own them. I can understand the attraction, because...
What do they do with lead? What do they do with the silver stuff?
And bauxite and... You know,
magnesium stuff, like what?
But they might create value, but I think it's going to happen over a long period of time. And if they, I think it'd almost be better off returning cash to shareholders than going buying. I can understand the attraction, but I think it's a sell.
Okay, so a little bit of divergence in views. This is fantastic, should be a good show. It is now also time for a viewer email. So let's go to our first viewer email of the night. We have this one from Giles, and Giles writes, "Can I please get the panel's opinion on Pro Medicus? Is it time to take profits or should I let the good times roll?" I think from memory, this one's quadrupled in terms of share price over the past year. Looks at imaging, high quality imaging, so doctors can have a look at it on their iPhones. Thoughts on this one, Evan? PME.
Yeah, it's a small cap biomedical stock. I mean, it's 220 million, so okay, it's not overly small, but the reason it's got up there is, as you alluded to, Julia, it's well and truly taken off, particularly since October, November last year, when it did actually see one or two contracts coming through. The volume is varied, trading is varied. So I can't see at the moment that it's got a financial system that sort of looks at it, looking at what they've reported. They're still obviously in the exploration phase. They're spending a lot of money to get themselves up and running. There's no net profit yet. Earnings have been growing. Like you can see that. There's no doubt that earnings have been growing. And that chart clearly shows you that they are moving in the right direction. It's an interesting one from the fact that they are the kind of stock that will turn out like a Certex and turn around and tell you something amazing, or they could absolutely blow you out of the water. That's the risk with any of these plays. It's the risk with any sort of new upcoming, what looks like a biotech company is probably a better way to explain it. And look at what's going on in the US stock at the moment with regards to biotechs. They've had an incredible run, but in the last 6 to 12 months, there's been several of them have actually sort of gone under. So yes, the question was, do I take profit? Possibly. Look for a pullback towards that $2 handle, maybe even as low as $1.50, and then maybe load yourself up again if you are really, really invested in the story. I just think there's no news, and I can see nothing there. As I said, there's that $9.5 million deal with University of Florida is the only major thing that I can see that's happened in the last 4 or 5 weeks that can really justify that. So until you get more information, it's going to be one of those stocks that just is a trading stock, and that's what it clearly is. So therefore, maybe, yeah, take your profit, look for those next limit levels.
Okay, so Evan's saying taking profits. Now, the stock's up 154% over the past year. It is a tech company. I mean, they look at software in terms of diagnostic imaging. What are your thoughts in terms of mixing technology together with healthcare?
Well, it can be very profitable. I've never heard of the company, so I won't go into the company's fundamentals. But you know, certainly hospitals, private health insurers, etc., and doctors are investing significant amounts of money in this area of the market to try and increase efficiencies. So I guess if they've got a good formula there, Julia, it might be worth having a look at. But without, it seems to me it's like doing well for a reason. It's not like it's just suddenly taken off, which is probably a bit of a better sign. And I think Evans may be right. Like, it might sort of pull back. But I'm not saying that with any sort of knowledge of the company.
Okay, so looking at Pro Medicus, it looks like an interesting company. They should be bringing in some revenue more towards the end of the year with some of these contracts that have been announced. So an exciting phase for the company where it has been ramping up revenue growth, but obviously still, I guess, a part of the market which doesn't get too much attention. $220 million market cap, and the stock code PME. Now we'll be back with more after this short break, but if you'd like to speak with our expert panel, our phone lines are open on 1300 30 34 35, or you can email yourmoney@skynews.com.au.
Technology is revolutionising shopping. At The Iconic, our success comes from sourcing the latest fashion from top Australian and international brands and getting it to our customers fast. And that's where StarTrack delivers. Their unrivaled network means our items can be delivered same day, next business day, and even Saturdays. In the fast-paced world of e-commerce and fashion, delivery is everything. And that's how StarTrack gives us the competitive advantage.
3D printing is changing the world. Let 3D Create and Print change yours. Learn how to design and print anything that takes your imagination. Build your own 3D printer with easy assembly guides and weekly design tutorials. 3D Create and Print, Part 1 at newsagents now.
She's in the middle of buying a new home. Well, they do say it when something's run well. You don't notice it. Welcome to HSBC Premier. Your personal economy in good hands.
Small business. It's the engine room of our economy. And with over 2 million of them, that's 96% of all Australian businesses. And according to the latest intergenerational report, we need to work smarter and more efficiently to improve our economy in the future. That's why a set of changes has been introduced in the federal budget. Small business will get an immediate tax deduction for a wide range of key business assets. The package includes a 1.5% tax cut for small companies, while small partnerships, sole traders and trusts get a 5% tax discount. There'll also be less red tape, helping business owners get on with running their business. Because if small business can get a boost, employ more people and prosper, so can our economy. To find out what the changes mean for you, visit budget.gov.au. Authorised by the Australian Government, Canberra.
On the next Rich Show, George Brandis, Australia's Attorney General, will ask him what happened in that cabinet room. Also, Stephen Barley, the Mayor of Blacktown, says they do not do the wrong thing out in the West. As Struggle Street said, no one even breaks wind in Blacktown. On the next Rich Show.
Welcome to the Shares edition of Your Money, Your Call. We are still taking your calls on 1300 30 34 35, and you can email in yourmoney@skynews.com.au. And we now have Max on the line from Perth. Max, welcome to the show. What's your question tonight?
Thank you for the great show and the new hairdo. Ben, I'd like to get your opinion on Fisher & Paykel with the FPH, I think it is, and also Healthscope.
Yeah.
Sure. So looking at the healthcare sector, we don't really hear a lot about Fisher & Paykel because they are New Zealand-based. But what are your thoughts?
They are, and they're a liquid here, so you can buy stock on the Kiwi exchange and then shunt it to Australia. You can, like a retail investor can buy it and sell it here, but you know, for instos, it's certainly too illiquid to purchase. But we own a small amount of Fisher & Paykel. They actually just reported late last week, and this company just keeps on giving. You know, it was another result where the earnings came in better than expected. You know, my view is that this industry as a whole continues to grow, and the three main players, which are Fisher & Paykel, ResMed and Respironics, are all, you know, they're moving market share between each other, but the market's growing faster than the market share gains and losses, and all three are doing well out of it. And I think the trend's going to continue. Fisher & Paykel's growing at the fastest rate of the three, mainly probably because it's off the smallest base, but it does have some pretty interesting technology. And I thought the result actually gave some good read-through for ResMed as well, which kicked after the result came out, mainly because they said in the mask division, which is ResMed's biggest product, that they had lost some market share. So that's probably been to ResMed, which has been a bit sort of whippy at the moment.
They've lost market share, but you know, revenue is still up 22%.
Yeah, with that product, but they make the flow generators, they make some other products as well.
The other issue with obviously what happened with ResMed was that article that came out 2 or 3 weeks ago, and that's what that chart there clearly shows you, is when they showed that there is their respiratory with their cardiovascular treatment showed that it actually increased the likelihood of mortality.
Yeah, but
very small part of their market. But
well, it's actually not a part of their market at the moment. It was hopefully going to be a future product for ResMed in another few years, and a number of analysts hadn't even factored it into their price. So to us, that was a good time to buy.
I bought.
Yeah, good. I think it was on the show last time. I said it's a good time to get into it.
I love ResMed. I think it's a fantastic company. It was just a very interesting situation for it to find itself
weird.
in. Very weird situation, and they clearly continue on their continuous disclosure. What they're coming out of, the numbers coming out of the US are amazing, and their mask particularly is, yes, it's their stable earnings, but it's the respiratory machine that's really driving growth in their earnings and their margins, which are up 63% last time I saw.
And the other stock.
And it is, you know, that health tech stock you're talking about before, Julia, they're doing a lot of stuff in that space. When you hear Mick Farrell talking, the CEO, they actually signed up a big agreement with Microsoft recently, where Microsoft are going to be using their technology in some of their products.
Wow.
So he's very excited about that. And I think there's a lot of value in that company that we don't really know about now, because we don't know what's going to come out of it. But you know, I think it is in there, and there'll be future earning streams for them.
So this is ResMed, not Fisher & Paykel?
This is ResMed, yep.
So positive on ResMed, positive on Fisher & Paykel.
Yes.
What about Sonic Healthcare, which was the other stock?
Healthscope.
Healthscope.
I'm not so keen on Healthscope. You know, I know it's done well, but to me it trades on a very similar earnings multiple to Ramsay Healthcare, which is a stock we do have some exposure to, but its earnings margins are about half of Ramsay's, and I think the management of Ramsay's better. I think they've got greater opportunities, particularly in China, which is the big potential growth market for them. And I think there's still more to come out of France, where they took over a company that they owned a minority stake in for a number of years. And I think there's more synergies and stuff to come from there. So for me, it's not so much I don't like Healthscope. I just think you've got a much better option in Ramsay. You know, you're not paying any more for it, but I think it's a better business and it does the same thing.
Okay, and Evan, any favourites in the healthcare space?
I think the only one that we haven't covered, and the one that it's not just healthcare, and the one that I quite like and has been moving up there because it's got US dollar tailwinds is Ansell. I know it's one that a lot of people sometimes are very critical of, but I think what they've done over particularly the last 2 years, with some of the very good strategic acquisitions going into their Hyperflex brand has been a major part of it. Everybody believes that they are more of a healthcare company. Yes, they have their medical and their sexual wellness division, but it's actually their protective products and their industrial products that actually do incredibly well for them and makes them up around about 45% of their earnings, and they are incredibly diversified across that whole brand. And I think that's why Ansell is one that I really, really like. The South Korean assets have been an absolute godsend with what they're coming home in margins. What's going on in Europe and their numbers there are also very, very clear. So I'm pretty sure that was Mitas, the one they picked up in South Korea. That's been an amazing pickup, $45 million, and it's already seeing EPS accretive of around about 10% in terms of what they were wanting. It's bigger than they were there. So Ansell's the only one I'm really excited about. I agree completely with regards to Healthscope and Ramsay's. I think Ramsay's division, France, is clearly showing that's been a great opportunity. It's growing, and I think China is clearly there. The only one we haven't touched on is the super premium that is CSL.
Yeah.
I can't justify it when it gets to sort of into the 90 handle. It's a beautiful company, and the price premium is amazing. I understand that, and I remember sitting on here with you a couple of times having a chat, but it's such a fantastic company, but I just, again, it's obviously got a level now where it can't go through, and even with the Behring division absolutely powering ahead in the US, and the fact that Baxter's slipped up a couple of times has also helped it. Its earnings look fantastic, and I think they'll get bigger. I just don't think the multiple will ever grab, value investors, and I think that's its issue at the moment.
Okay, so Max, hope that helps you out. Plenty there in the healthcare space. I think we've almost covered the whole sector there for you. So I hope that helps you out with Fisher & Paykel as well as Healthscope. Let's go to an email now. We've got one here from Darren. And Darren writes, can I get the panel's thoughts on Regeneris? It has increased sharply over the last week with no news flow. So having a look at Regeneris, and the stock code there is RGS. So there has been approval for a personalised cancer immunotherapy trial. And this seems to be all the go at the moment, Ben, trying to use your own immune system to fight cancer. If it's just approval for the trial, still early stages, what are some of the things you look for here?
Cash,
Yeah.
and cash, and cash. Because how often do you see it? Good announcement comes out, stock spikes, bang, capital raising. They can get it away into that liquidity, and that dilutes everyone, takes the wind out of the sails of the share price, and it slips back until the next exciting announcement is made.
Absolutely. So really good point there. Have a look at how much cash, because they aren't making money. In fact, if you have a look at their profit announcements, all on how they're slimming down on their losses. But of course, Evan, having a look at the Japanese government's announcement not too long about the acceleration of some of the cell therapies there, is that a positive?
Possibly. Unfortunately, with the way that cancer treatment is working at the moment, and Ben is exactly what I thought when I heard it, is the amount of cash required to go through the clinical trials treatments and the actual clinical evaluation process is a mountain of money. The company's worth $29 million. So it's got a long way to go. It's a massive risk for that reason. I mean, the ones to look at that everybody knows about is Certex, and the roller coaster it's given you in the last 3 months are amazing. Cancer is sort of like the holy grail. It's like hydrogen power in sort of the physical space where car makers are trying to find if it's batteries or some form of energy source. It's a similar idea. If you can treat cancer and find a treatment for cancer, you will be infinitesimally rich on the dot. It's for that reason I would rather go with the ones that are through their clinical trials. If you want to do it on an investment, have a look at Certex. Yes.
Certex?
Yes, I would. And I've been saying that pretty much since they had that massive fall off. The overreaction to that story was a monumental issue in the fact that the evaluation of it was was poorly done with that 24 hours of trading. And as soon as it went to $15, it was like, this company isn't scorched earth area. This isn't the end of it. It's not stopping treatment. It's clearly shown you on a secondary and as a complementary medicine that it's incredibly good. So even with what we saw on Saturday from the Surflux study and the final evaluation, it clearly showed that Certex is a company that will be well and truly to invest in. The clinical free days of tumours are clinically, statistically proven with chemotherapy. The hope was that it wouldn't need chemo. It does. That's fine. Cancer is an incredibly hard beast to tame, and for that reason, it's a great product to look at.
Okay, so a few stocks there. Once again in the healthcare space. Let's go to our next call. I've got James on the line from Sydney. James, welcome to the show. What's your question for our panellists tonight?
Thank you for taking my call, Julia.
You're welcome.
I would like to know what is happening to Medibank Private.
Oh, great question.
The price has come down. Is it a good time to buy some more?
Sure. If we can bring up the chart on this, because it looks like a mountain up and then straight back down. It looks like it's getting pretty close to the IPO price that a lot of private investors would have picked it up actually below. So it's $2.05 today. What do you think, Ben?
We went into the float. We sold out at about 241, and James, we sold out with a fair bit of concern when they reported their maiden result, mainly because I think the industry is starting to see much higher levels of churn. And although price increases should benefit these companies, I think it's actually starting to impact, particularly on the big players, as in Medibank, because I think private health insurance is reaching a price where people are really thinking, geez, how expensive is this becoming? And I need to look around. I know this personally because I did it. We got up to $400 a month. We're paying for a family of three. It's $5,000 a year, and you're starting to think there must be a better option. And I think Medibank's the one that's been picked off. AHM's doing well, but I actually think it's a sell, Julia. If I was still in it, I'd still get out of it because although I don't think it's going to fall over, I don't think it's going anywhere in a hurry.
Okay, now we do have to go to a break, but I do want to talk more on Medibank Private, so we will be back with more after this short break. If you'd like to speak with our expert panel, please give us a call on 1300 30 34 35, or you can email us at yourmoney@skynews.com.au.
What makes a great boot? Well, we think it's the 80 pair of hands that go into the creation of every pair of RMs. Our premium boots are now delivered to more than 600 stockists and 70 retail stores across Australia. And that's where StarTrack steps in. They ensure our boots are handled with the same care and attention wherever they end up. Whether it's a pair to the bush or hundreds of pairs to our stores in capital cities, StarTrack gives us the competitive advantage.
It's true, great wealth is built in the stock market over time. It's also true, CoSec stock picks have outperformed the stock market on a consistent basis. See why some of the most wealthy and successful investors have switched to CoSec. Register for your free stock report with insights Michael Kadari reserves for his clients. CoSec, your investment edge.
We're all connected by the thrill. Now you can be even more connected with the all-new UBet app. Download the UBet app today. For the thrill of it. UBet.
3D printing is changing the world. Let 3D Create and Print change yours. Learn how to create games, jewellery, useful items, limited only by your imagination. Each edition comes with components to build a 3D printer for your own home. Plus easy assembly instructions. With the magazine, Master the Art of 3D Design, with weekly step-by-step tutorials, easy-to-use software, plus access to exclusive designs to download and print. 3D Create and Print, Part 1, only $4.99. Out now.
Watching patterns is how we help to stop fraud in its tracks. American Express. Realise the potential.
Welcome back to the program. I'm Julia Lee from Bell Direct, and joining me on the panel tonight we have Evan Lucas from IG and also Ben Clark from TMS Capital. So if you have a question you'd like answered, please give us a call on 1300 30 34 35, or you can email yourmoney@skynews.com.au. And it is now time for a viewer email. So let's go straight to this one from Craig. And Craig writes, what are your thoughts on ZipTel's huge recent growth? Wow, can we bring up this chart? ZIP is the stock code. The stock's gone from about 20 cents back in July to almost $1.20. In fact, the stock was up 19% today on no announcement.
Yep.
What do you think, Evan?
I'm going to look at this from a point, looking at the company and looking at the earnings. There isn't much there to tell you. It's a very small company in terms of what is there, but that chart clearly shows you that there is some trading going on there and some fairly heavy trading. The volume in it is basically unchanged. There is no volume changes in terms of what's happening. There's a clear break of what, if you actually have a look on more of a candle chart, you can see that there was resistance around about $1. It hit it 4 times in the last week and it's obviously clearly broken through today, and that's what's driving it. That is a technical move rather than actually anything off the company's number. And that, I think, is an interesting one because there was an up channel, and you can see that as well from that chart, and they've broken the upside of that. So it's a technical trade. It is not down to anything specific, as you alluded to. You know, the fact that Brett Lee signed up as a global brand ambassador on the 27th, I don't think has had a huge material impact, but you know, stranger things have happened. But
didn't help. I remember when Adam Gilchrist signed up with TFS, and it didn't do their share price any favours in the long term.
Sandalwood, really?
Yeah, I don't know why. Well, India, I guess.
Yes.
Yeah, I think, Julia, there's a lot of concept stocks in the smaller tech, biotech sort of market with what could be incredible, groundbreaking ideas or products. I think you just got to be careful in that 99 of 100 don't ever come to anything, but there will always be one that does, and this could be it. And maybe the guys who are buying this today are onto something. But I think one thing advice I'd always give is, you know, when are revenues going to start to flow? When are earnings going to start to flow? And don't fall in love with the concept of what the company's doing, and always focus on the financials, because they will be what dictates the share price at some stage. In the short term, you can get depression, enthusiasm, euphoria, all those sort of things, and it doesn't need to make sense. But in the longer term, the financials will dictate the share price. So you need to work out what you think they're going to do.
Okay, so $5 million was raised through an institutional placement back in November last year. Share price has rocketed since then. You know, they have a landmark agreement to distribute through 7-Eleven stores, and they look at VoIP and as well as overseas SIM cards when you travel.
Yep.
Any of this getting you excited?
Well, I remember we had a VoIP bubble about 2 or 3 years ago. We used to get a lot of calls on the show about, I think there was 3 or 4 stocks that went up by 10 to 1,200%, you know. And I'm pretty sure that all of those stocks have since gone bust or are trading at 1 or 2 cents. So it probably highlights what I was sort of saying, is that at the time everyone was like, this is where the industry is going. But of course, it didn't play out like that. And, you know, there are companies like Apple and etc. that can do these things a lot better.
That's the issue. The competition in this space is ginormous, and they are not a first mover advantage as well. I mean, they're actually competing against some very big European names that have had this space for a long, long time. The one to really clearly point out to you in that space is Lebara. Mobile does something very, very similar across the European markets in terms of their offering. So I'd agree. It's an interesting concept. It's an exciting concept. The other thing, when you do have exactly what Ben just described, is that you get better entry points. And you know, if they do survive and they start generating cash, I promise you they'll be back at 50 cents before they start getting that point. So yes, they're up 50% from there and through it, but there will be huge volatilities in it before it actually becomes a one that we probably become really interested in.
Okay, so that was Ziptel. ZIP is the stock code. Phenomenal growth there. In fact, just having a look at how it's grown, the stock up, can I even read this? 115,000% over the past year.
Wow.
Yeah,
that's pretty cool.
It's an amazing. And it's exactly what we're talking about in the fact that it's the new space, like the old days in the mining space, where you'd find an exploration company that all of a sudden literally strike gold, or for us here iron ore, and it would just go bang.
Yeah.
Fortescue, key example. Could it be that in the tech space?
Yeah,
maybe, but
This is incredible, up 43% over the past week.
Yeah.
But that was Ziptel. ZIP is the stock code there. We do have our next caller on the line, so let's go straight to Tony from Sydney. Tony, welcome to the show.
Good day, Julia. I was just wondering if you guys know anything about Collection House, and just really quickly, is this a good time to be getting into REA Group?
Sure. So Collection House and REA Group. Ben, what do you think?
Yeah, I know a bit. I've met with Collection House actually. It was a year or two ago now. They were a very well managed company. I sort of met with them because we were in Credit Corp at the time, and we were sort of interested in what was going on in the industry. It's a much smaller play, but they've grown very astutely. So these guys buy debt ledgers principally from the banks, but also from companies like telcos, etc. So if you've got a bank of people who are 90 days plus in arrears, the bank will maybe bundle those ledgers up, sell them to someone for 60 cents in the dollar, and then they try and get 70 cents in the dollar out of it, and that's their profit. Credit Corp has been probably the best managed company, I would say, in the ASX 200 when you think of where they came from in the GFC without doing a capital raising. It was just a phenomenal move by them. But Collection House has been very good as well. My concern at this stage, and we're out of Credit Corp now, is that with interest rates at 4.5%, with unemployment still at pretty low levels, and with pretty good times in the economy here, I don't think the level of defaults are that great. And I think the banks are selling these ledgers for much higher prices than they've been able to in the past, because the collection firms can get more out of them. And it's probably, you almost want to buy these businesses when times are not good, and I wouldn't say now's probably the time to be getting into them if you're not there yet.
Okay, so very much a cyclical business. I mean, looking at Collection House, is it the type of business that you like?
It's an interesting business, and I agree with Ben. It's very interesting way of actually generating income. I mean, obviously, it takes away bad and doubtful debts off the balance sheet. I mean, the banks love them for that reason, because all of a sudden they're not holding it. So we were talking about the fact that banks are obviously very much tier one geared, book. This is a book that is geared to the downside with regards to where it's sitting. So Line Finance does an incredible business. There's no doubt about that. They have a huge turnaround. They have a huge margin because of the fact that they do get such a cheap rate and can get, I've seen them get as much as 80 cents in terms of the dollar in terms of what they've done. So, but I agree, if you look at what the banks are reporting you, bad and doubtful debts are at some almost multi-year, almost decade-year lows. So right now is probably not the interesting one. I mean, again, the fact that interest rates are low, the fact that confidence in the next 3 or 4 months might take a beat up, I still don't think that's going to be a problem for them. And I think that's also the interesting thing. So yes, they're an interesting business. Yes, 2011 and 12 was where you clearly got a big boost to earnings, because that's when, BDD was high. It's not right now. Look, it's a stock that will exist because there is a function for it all the time. There is, no matter at any point in the cycle, there's always bad and doubtful debts. Just not right now.
Okay, and what about REA Group, Evan?
REA Group, well, let's have a look at it, what a stock it is. Unfortunately, it has had a fairly big slide over the last, 6 weeks, 7 weeks?
Yeah, since it's quarterly.
Yeah, and the quarterly numbers did look, for REA anyway, a little bit sickly.
Softer, yeah.
And that's very hard considering they're still double digit, but they weren't good enough. And they're trading before that, when they got up to almost 50 bucks, they're trading on a multiple in the high 20s, early 30s. So that's what I saw. I still think REA clearly is one of the best companies in the ASX. Clearly, when you listen to anybody that actually owns it, particularly somebody like News Corp or somebody like Fox Group, they continue to champion the fact that they are so proud to be part of that digital real estate space. you listen to Fairfax with Domain as well, and the fact that
Yeah,
Domain...
it doesn't worry you that Domain's reinvigorated, seems to be gaining some traction.
Yeah, but their market share across the globe is what they're also part of. They've clearly showing that they're still the market leader in Australia, and their Italian business, their US business, they're still doing incredibly well and firing ahead. Their model is stronger. They're still ahead of the curve and still the one-stop, or at least the first-stop shop for when you go into that. The subscription model gone, much better. It's now obviously on a listing model. It's much faster turnaround. Margins are better. It's a better opportunity model, and I still like REA Group and what they're offering.
Okay, so liking REA Group, I mean, Domain grew revenue 27% January to April. REA Group has always been the market leader in this area. Is it slipping, Ben? Or
I don't think so, Julia. I think the biggest thing that's working against it is how hot the housing market is in Sydney and Melbourne. And if you speak to anyone who's trying to buy a property at the moment, the one thing they'll say is there's nothing for sale.
That's true.
And I think the reason the earnings in the last quarter were down was that listings were down 9%. And I don't think that that's gone to Domain. I think it's simply that if you look, between $1 and $2 million in a number of suburbs in Sydney at the moment, there is nothing for sale. And that's, with what the housing market, particularly up here in Sydney, is doing, it's not going to last like this forever. The other big thing that's happening in Sydney is a lot of agents are selling properties off market because they can. They can approach a guy, say, if we can get you $2 million for your house, would you sell it? And the guy's like, if you can get it, I'll take it. And they're just taking groups through, and it's so feverish here in this city that people are buying it, and that ad isn't hitting REA's boards.
That's a really good point. I've heard stories of busloads, like little mini buses doing
driven
tours.
around.
Yeah.
And look, I don't know when this is going to end, but it will end in the next year. And so I'm very comfortable buying the stock at the moment because I think these conditions are unsustainable. And with Domain, look, I think REA, 70% of people who are looking for a house are exclusively on REA. If you're not on REA and you're selling your house, you're crazy because most people don't know it's for sale. Yep. And Domain, I think, in Sydney, which has a bigger presence, some people are now dual listing the property on both websites, whereas they might have just been REA before. But I don't think it's come in the expense of REA. I just think Domain's growing off a lower base.
Okay.
So, I saw Hyperion increase their stake last week. They're the second largest shareholder in the business. They've been in there for, I think, nearly 10 years. It's the largest holding in their fund, so it's pretty ballsy, excuse the word, for them to increase their stake. And they're great managers. So if they're buying more, I'm very happy to buy more.
Okay, so strong buy from Ben, liking REA Group, and I think you've been accumulating.
We've been buying the last week. Yep.
So been buying in the last week, looking good. Collection House, though, very much a cyclical business, so looking for bad times and hard times in terms of the economy as well as higher interest rates to see that as a buy. Let's now go to an email. We've got a viewer email here from Mark, and Mark writes, just wondering, what are your thoughts on Auswide and Cenex? It's a little bit different. Emma, we might go to you first on ABBA and SXY.
I'll take SXY. I know Cenex well enough.
I wanted to take SXY.
Sorry, mate.
You can both.
Yeah, we can talk about it. I mean, SXY is obviously an interesting energy play in this current market, considering the fact that it is very unconventional gas in the Cooper Basin. So it works very much right next door to Santos. Santos, if you listen to them, will tell you about how amazing Cooper is. It is an amazing deposit. Let's not get that wrong. They obviously picked up Stewart Energy around about 4 years ago now, in 2011. Very good price, merged those two companies, and it did incredibly well off the back of it. It has, like every energy stock on the ASX, been completely caught up by the collapse in the oil price and the fact that whether or not unconventional coal seam gas trading plays are actually going to be something of the future when onshore US gas comes to fruition. It is a risk. It is probably looking for a farm-out opportunity. However, the assets that it does tell you that it has and in their tenements are incredibly good. Their flow rates are very, very high, and the opportunity into the future are very, very strong. It's a very well-run company. It's based out of Brisbane. It's certainly in the right area. It's got a gigantic player next door that is looking to fill its second train, and that's the other thing to be aware of.
Yeah. Interesting, SXY, and I know Ben's got something to say on Cenex as well.
All I can really add, I mean, we're not in Cenex, but I think it's a highly leveraged play in the short term on the oil price. If the oil price goes up $10, this stock could double, and vice versa. And that's because the vast majority of its assets are still in the ground, and it needs a certain price to start producing them, and it needs the energy market to calm down. I would say, like, you know, Drill Search, Beach and Cenex, Kerry Stokes has gone to 20%, I think, in all three stocks in the last month.
For a reason.
One of the greatest contrarian investors we've seen in Australia over the last 30 years. So, you know, if he's buying them, it's interesting. But I think, you know, oil could easily go back to 48, 50 bucks in the short term, and this could go back to 25, 30 cents and vice versa. So I think it's a flip of a coin short term, but longer term, oil will probably settle closer to 70 or 80 bucks, and you'll probably look back and think this was a pretty good buy.
Okay, so that's Cenex. I am going to put you on the spot, Ben, on Auswide. Backdoor listing on the 1st of April, so not too long ago.
Right.
It's now turned into a financial institution, so there aren't too many banks listed on the ASX. Looks like Auswide becomes Australia's 10th and Queensland's 3rd largest Australian ASX listed company. So looking at more of that regional space and the credit building society type of model. Any thoughts on what this area is like?
I hate backdoor listings.
Hate it.
That would be my first thought. And I was speaking to a client about this last week. If you're a business that's got a great business model and a great business case...
Tell the world.
Yeah. Well, I think you go and talk to instos and retail investors and you get a register that wants to be invested in your business. If you backdoor list, to me it generally means that the business case is much weaker, that they might not meet the ASX compliance requirements if they were to float onto the exchange, and they inherit a share register of disgruntled investors who have been sitting in some, you know,
mining company
that's gone broke, and they just want to get out. And so it probably means, you know, like, why have that start to your listed life if you've got really good prospects? You know, if you're a good company, you should be able to do it yourself. I know it's cheaper, but I think that can be a short-term positive, but medium-term not so great. So, look, I don't know anything about the company, but I would generally say I've seen very few backdoor listings do well.
Okay, so I guess the housing market is quite strong at the moment, so mortgage growth, still pretty competitive space to be in.
Yeah, the interesting thing though about an Auswide, or asking the second part of your question, Julia, is that regional banks have to fight so much harder to raise capital, and an Auswide is very clearly in its mantra trying to go through retail funding. Retail funding, and that is a real problem in this current market. Retail TD deposits, as we all know, are getting squashed by the day, and why would you hold your money in a TD when you can do things elsewhere? It needs TDs to actually raise the mortgages they need to do, and therefore the business model already is on the back foot. Look at what was coming out, despite the fact that, you know, Bank of Queensland and Bendigo and Adelaide Bank do incredibly well. Their margins are very, very skinny, and Auswide doesn't have the balance sheet that those two have.
Okay, so a very interesting question there. We were looking at ABBA, the stock code, ABA for Auswide, backdoor listing for Wide Bay Australia, which it was previously. And on that note, we are taking a short break, but we'll be back to answer more of your questions in just a moment. If you'd like to speak with our expert panel, please give us a call on 1300 30 34 35, or you can email yourmoney@skynews.com.au.
What makes a great boot? Well, we think it's the 80 pair of hands that go into the creation of every pair of RMs. Our premium boots are now delivered to more than 600 stockists and 70 retail stores across Australia. And that's where StarTrack steps in. They ensure our boots are handled with the same care and attention wherever they end up. Whether it's a pair to the bush or hundreds of pairs to our stores in capital cities, StarTrack gives us the competitive advantage.
It's true, great wealth is built in the stock market over time. It's also true, CoSec stock picks have outperformed the stock market on a consistent basis. See why some of the most wealthy and successful investors have switched to CoSec. Register for your free stock report with insights Michael Kadari reserves for his clients. CoSec, your investment edge.
Small business. It's It's the engine room of our economy. And with over 2 million of them, that's 96% of all Australian businesses. And according to the latest intergenerational report, we need to work smarter and more efficiently to improve our economy in the future. That's why a set of changes has been introduced in the federal budget. Small business will get an immediate tax deduction for a wide range of key business assets. The package includes a 1.5% tax cut for small companies, while small partnerships, sole traders and trusts get a 5% tax discount. There'll also be less red tape, helping business owners get on with running their business. Because if small business can get a boost, employ more people and prosper, so can our economy. To find out what the changes mean for you, visit budget.gov.au. Authorised by the Australian Government, Canberra.
We're all connected by the thrill. Now you can be even more connected with the all-new UBET app. Download the UBET app today. For the thrill of it. UBET.
On the next Rich Show, George Brandis, Australia's Attorney General, will ask him what happened in that cabinet room. Also, Stephen Barley, the Mayor of Blacktown, says they do not do the wrong thing out in the West. As Struggle Street said, no one even breaks wind in Blacktown. On the next Rich Show.
Welcome back to the show. If you have a question you'd like answered, please pick up the phone and give us a call on 1300 30 34 35, or you can always email us on yourmoney@skynews.com.au. And we have Paul on the line from Melbourne. Paul, welcome to the show.
Yes.
What's your question tonight?
Good evening. Firstly, you received an email about Pro Medicus, and I was just reading then that its wholly owned subsidiary has received FDA approved clearance for its mobile app. But that's not what I'm ringing up about. There's just two small companies, and not giant ones, IPH and Life Healthcare.
Excellent. So some more information on Pro Medicus, which we were looking at earlier on in the program. Whose share price just absolutely rocketed. IPH is another stock where the share price is absolutely rocketed. It wasn't too long ago that it came onto the market. I think around about the $2 mark. It's now about the $5 mark. What do you think, Ben?
It's frustrating. Well, we tried to get stock in the float. It was just as rare as hen's teeth, and I think everyone got tiny little holdings. And then, I think the stock almost doubled the first day it started trading, and it's just kept going up since, and it's done it on very little liquidity. So it's been, we've let it go, I think, Julia, but from afar we really admired what they're doing. They're in the legal game. They do a lot of work in protecting
intellectual property
and particularly in Asia. And I think it's a great growth industry and it's well managed. What I quite like IMF in the legal area as well, and I also reckon Slater and Gordon looks pretty interesting, which I've noticed has sort of had quite a decent kick up the last 2 days in a market that's been belted. So there's some buying there, and if they execute on Quindell in the UK, that stock's worth a lot more than it's trading at now, but it's not without risk, because if they stuff it up, it's worth a lot less. So
and that's the one they're waiting for, is to see how much EPS growth they can get out of the UK.
But by the time we know, the share price will be a lot higher or a lot lower. Yeah, so you've got to take a bit of a bet on it, and I think it could be worth, because the management team are excellent and they've achieved everything they said they would, despite a lot of cynicism, I would say, amongst fundies. And if they can pull this one off, they're in the big leagues.
Okay, so Slater and Gordon looking quite interesting to Ben. Back to intellectual property holdings. I mean, everyone seems to like it. They love the growth story. They love the Aussie dollar story because it's overseas exposure, but they don't like the valuations. Yeah. What do you think, Kevin?
That's the only maybe catch that you come with it. But as Ben said, I mean, it literally jumped 100% on the day. You got it for $2, you got it at $3 on the open, and it hasn't slowed down since. I agree with you that the chart still clearly shows you that there's momentum to the upside. Obviously, that could suggest, if you're a technical trader, that maybe $5 is a handle. So you could look, if it does come back towards that sort of mid to low fours, that's an area to pick up, considering there as well. I agree. Legal professions and legal listings, services providers that are the next up-and-coming space of the economy that people keep talking about are very, very exciting. There is, talk and idea around, Shine and whether or not Maurice Blackburn are thinking about similar things. That would be an interesting place. Legal is a services area that I think is very exciting over the times.
Okay, and Evan, life healthcare.
Yeah, one of those ones that was probably missed with the mass listings that happened in December last year. There was around about 20 listings all at the same time. $2 or $1 share. Can't remember. Again, imaging. We've been talking about imaging tonight, and it's particularly in radiology. It's got a lot of healthcare opportunities around Victoria, particularly. It's got 3 there. Really, really good quarterly and half-yearly number updates, which is why you've seen that massive jump at the first half. Basically, it came out at the end of January. Really good numbers, really good story. Clearly show that not only is it delivering on its promises, that its growth story is there, and that was obviously expanding its offering and expanding what they call their firms over the period. So life healthcare, one you may have missed, but a very exciting story.
Okay, so we've spoken a lot about the healthcare space, but I guess we miss life healthcare. It distributes higher medical products. So if you are positive, I guess, on that space and growth in that space, would you be positive on?
Well, yeah, a lot of surgery products and stuff like that. An issue for us, Julia, has become that, and it's a good problem to have, is that our tilt to healthcare has become quite substantial in clients' portfolios, and I do have a little bit of concern that, once a few of them correct, they could all correct very quickly. So,
and they're all offering you a premium too.
Yeah,
that's the thing. You're having to pay a premium, and that's the concern.
Everyone likes the story, I think, and this is one area where our market and our country bats well above its weight. But new healthcare stocks, given our exposure, is probably not something we're looking to increase at the moment.
Okay, so lots of interest in healthcare given it has run very quickly, and of course that Aussie dollar exposure. On that note, that's all we have time for today. Thanks so much to our guests, Evan Lucas from IG and Ben Clark from TMS Capital, for a fantastic show, and to you, our viewers, for all your calls and your emails tonight. Until next week, I'm Julia Lee from Bell Direct. Thanks for your company.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned.